Hello, everybody. Thank you for taking the time out of your busy Saturday to join me here for this presentation of flexible premium deferred annuities. Uh, my name is Max, and the name of the agency is River Rock Financial Group, LLC, which is licensed in Georgia, North Carolina, and Texas. Once again, I want to say thank you to everybody that's watching this, and I hope and I know I'm pretty sure that you'll gain some valuable financial insight as to how to get ready for your retirement. So the focus of this particular presentation is for your future retirement plans, and also to make an understanding of how to create a supplemental retirement stream of income through a flexible premium deferred annuities. There are several types of annuities. The FPDA is just one annuity. This particular annuity is very detailed in how, well, not detailed, I'm sorry, let me back up. This annuity is very low risk. That's what I want to say. It's very low risk, and it's for individuals that are willing to have a delayed gratification when it comes to their finances. It's also for somebody who's able to see the future of their income going up. Usually flexible premium deferred annuities have a minimum, and the one I will share with you today is the minimum is $100 a month. This particular product also has a limit as to how much you can contribute every year. So this particular product I'm going to share today, the limit is $25,000 a year. And that means that the person, whoever decides to contract a flexible premium deferred annuity, is able to increase their contribution to their annuity over time. So that's the beauty of the flexible premium deferred annuity. So without further ado, let me go ahead and get started. But first, let me cover myself. All these examples are for illustrative purposes only. These are not representatives of any particular investment or life insurance. This is not an offering of an annuity. This is not an offering of life insurance. You only do that once you get a contract for an annuity or any other type of insurance product. Values are shown before tax. All withdrawals from a retirement plan are taxable as ordinary income. Please consult your tax expert and advisor. So again, this is a type of insurance product, life insurance product, but it is an annuity, which means there are no medical questions. There are financial questions about where the money comes from. So without further ado, I'm going to go ahead and get started. All right, here we go. Slow it down a bit. Okay, so insurance has been used by the rich and wealthy for a long time to avoid taxes, to pass down wealth, to create income streams, to avoid probate once a person passes on. It's also been used for educational funding. It's also been used to cover businesses. It's also been used to cover key employees. The list goes on and on about how insurance has been used over time by the rich and wealthy. This thing is slow. All right. A little bit more information about insurance. The accumulation power of insurance is unprecedented. I'll share at the end of this presentation also how time and money are related and how they use each other. So again, the rich and wealthy have used this to accumulate passive wealth over time, protecting themselves and their families, and pass down generational wealth. A lot of people in today's society want to talk about how the rich is unfair, the wealthy is unfair. And I'm not saying some of those comments are unfounded. However, I am saying that why not get started on building the wealth for your family, building the wealth for your community, and creating wealth for yourself while you're here and when you're not here. In the 1600s, ships sailing from the old world to the new world were insured. Uh, Back in medieval times, and a lot of insurance companies started because of the guilds, the people that made the ironworks, the craftsmen, the leather, the weaponry, on and on and on. Those people got together and created their own insurance companies to cover the people that were working in those crafts, their families, if something happened to them or if they passed on. Fire insurance was big in the 1500s. As a matter of fact, a lot of insurance companies started as fire insurance companies. If something caught on fire, you would have paid into an insurance product, and then they would come put the fire out and then rebuild your house. That's why a lot of things that we use in today's world are a direct reflection of what happened in the 14th, probably earlier than that, the 14, 15, 1600s. Hammurabi, the ruler of the Babylonian Empire, required merchants to insure their products. And then, so as you can see, this has been going on for a long time, and a lot of the population does not understand how to use insurance. There are uh, a lot of different excuses about why, how, and there's another presentation, but I'm going to touch on it for a second. What you have to do is get educated about what insurance is. And a lot of the misconceptions, preconceived notions about what insurance is and how to get it, and it's too expensive, or I don't have the health, or I don't have the money. All those are really, in today's world, things that can be overcome. Insurance providers have a lot of different ways to get involved. Okay, so what's an annuity? It's a contract issued by insurance companies, financial institutions, because insurance companies are financial institutions, whether it's property and casualty or life and health insurance, they are financial institutions. Okay. It's a contract issued by a financial institution to receive funds, invest those funds, and then at a certain time period in history, distribute those funds to the owner of the annuity. There are two phases of an annuity. Accumulation, that means you contribute to the annuity, whether it's over time or single premium. Those are your accumulation periods. And annuities guarantee a fixed interest rate. That's the beauty of an annuity. It's a guaranteed fixed interest rate, okay? Unless it's a variable annuity, which I'll talk about here in a second. Then there's the annuitization period, which is the income period, which means that's the time where you're receiving an income for your annuity, from your annuity, I should say. So what is an annuity? It's a contract between the owner and the financial institution, aka the insurance company, to receive funds, invest those funds, and then create a stream of income to the annuity owner, which is called the annuitization period. Okay. All right. My side button. Okay. So here there are no medical exams for annuities. All annuities accumulate value with interest to the owner. Interest rates vary. Interest rates for annuities change monthly sometimes. But the basic spectrum is 3 to 10% on annuity funds. Okay. And of course, the more funds you invest, like what the one I'll talk about today, the more interest will compound or over time. What that means is the owner will receive larger amounts of payouts or streams of income in the future. You can also roll over or transfer funds from the from things like 401k into annuity accounts. It doesn't have to be 100%, but you can roll funds over into an annuity and then let that money further gain interest. There are stop losses, which guarantee your gains. You do not lose your initial investment. Okay. It's an excellent, excellent retirement supplement. An annuity is an excellent retirement supplement to any other retirement plans you have. As a matter of fact, a lot of millionaires take portions of their wealth and roll it into annuities and let's just let it sit there. You'd be surprised at what 5% would do, or 7% would do on $1 million or $500,000. Because you can put $1 million in an annuity. Just imagine the power of that interest on $1 million over and over and over and over again every year. And so people a lot of times don't understand how do rich people continue to get richer? Well, they keep getting richer because they've been taught this from a lot of them been taught from kids, or they go find other people to learn from. The vast majority of people take extra money and blow it on shoes, and gadgets. I'm gonna just leave that right there. All right, let's move on. Okay, so you have options to pay out. Okay, immediate and deferred. Today we're talking about deferred. We're not talking about immediate. I'll talk about immediate later on, but deferred, which I kind of talked about already a little bit. The client pays a premium over a time, accumulation. The client determines when the income starts. Also, the client can determine the frequency of payments. It can be monthly, it can be quarterly, it can be semi-annually, or it can be annually. Some people take a lump sum at the beginning of the year, the end of the year. Some people take 2 payments a year. Some people take 4 payments a year. And some people take a payment every year. Or I should say, receive income on those at those frequency ranges. All right, so you have a fixed annuity, which is what we're talking about today. The flexible premium deferred annuity is a fixed interest rate. Okay, some carriers, some insurance companies may allow you to, even in a fixed annuity, or I should say a flexible annuity, some insurance carriers will allow you to gain more than the fixed amount stated when you sign a contract, an annuity contract. So most will have a fixed amount of interest that's guaranteed at the beginning of the annuity, and they won't go any higher. If it's 3%, 4%, 10%, that's what it's going to stay at. Okay. All right. An annuity is a great hedge against inflation. But again, on the fixed deferred annuity, we're deferring receiving payments. That's the key. You have to defer. Don't be like me. I had one annuity, a mutual fund. I cashed it out. Now I look back and say, man, I should have done that. Okay. Because now that thing will be worth millions of dollars. So you have to, so in order, one of the reasons I do this is to teach other people what not to do. Okay. All right. Annuities are low risk, especially fixed annuities. There are tax advantages. That means that your money grows tax-free, which means you can use an annuity for, let's say, for example, you just had a newborn and in 20 years or 19 years, you want to help the college fund. Boom, annuities, fast, easy. And there are a lot of different product types. And if there is a death benefit attached to it, which, let's say, for example, you put some money in an annuity and it's there, and your beneficiaries will receive what's there once you transition. Okay. So if you had $1 million in annuity and whatever's left over, your beneficiaries will receive that. Okay. You can also create an annuity payout option to actually pay once you pass on. So there are several different benefits to an annuity. So then you have the immediate income annuity, which I'm not going to spend a lot of time on because I want to stay focused on the flexible premium deferred. But the immediate annuity, since it's here, is an annuity in which you can take a single lump sum, place it in an annuity, and then start receiving a stream of income from that annuity. Now, these annuity products have minimum premium requirements, minimum contribution requirements. Some 5,000, some 10,000, some 20,000. There are single premium annuities or immediate income annuities that allow you to place $1 million there. So when you're talking about how rich and wealthy people continue to get richer and richer, this is one of the ways. All right, let's move on. Then you have the indexed annuities. This gets a little bit more detailed. Okay. When you place your money in an annuity, it does have a loss stop prevention mechanism, which means your annuity is now tied to the market indexes like the S&P 500, the NASDAQ, etc. I'm not going to spend a lot of time on this either. I am going to touch on it. But the great thing about the index annuity, you participate when the market rises, when the market appreciates. You participate in that, okay? You don't lose your initial investment. That's an index. The key word there is index. All annuities have a key word that allows you to understand what it's doing for you, okay? And then you have the variable annuity. The variable annuity is kind of like the index annuity, where it's tied to certain sub-accounts, mutual funds, etc. And it's a little bit higher risk, okay? But you can, here's the thing about the variable annuity. It's tied to different accounts, sub-accounts, but you can defer the income. You don't have to pay any money. It's almost like a deferred annuity, but you're investing in several different vehicles. This is a great thing. And this is for somebody that uh would like to have a higher risk option. All right, so without further ado, let's talk about the featured product I'm going to share today. This particular carrier, Royal Neighbors of America, they specialize in annuities and life insurance. So I want to show you, they have the single premium immediate annuity, which I talked about. This a minimum of $5,000. Okay, and then they have this is what we talk about today, the flexible premium deferred annuity. Okay, it's great. All of these are great for retirement, but this has a minimum guaranteed interest rate. Okay, they call it minimum guaranteed credit rate. And the accumulation period is, you can accumulate this thing. I'm gonna show you here in a second. A young lady I did annuity for. I show her the illustration is up to 30 years. 30-year accumulation period at $100 a month. So without further ado, let's go ahead and show that. All right, so this was done in 2023. This particular product I'm highlighting is the Steady Choice 2. All annuities have their own little own little name, and so it's a fancy name for their FPDA. Okay, so the key terms: flexible, which means the premium is flexible. If this person wanted to say, okay, I'm going to increase my contribution by $50 a month, they can do that. They call and say, or call me as your agent and say, hey Max, I want to increase my contribution by 100 by $50 a month. Then I would call this particular carrier, and then we would do the things necessary to increase it to $150 a month. Okay. All right. And then that's flexible. The premium, flexible premium, that's what it is. The premium is flexible. And then the deferred, which means don't touch it. So let me talk to the people. And a lot of people are like this. Deferred means delayed gratification. So what I suggest is, do not touch the annuity until the interest rate. I'm sorry. There's a penalty you will get if you start extracting money from the annuity, right? A lot of agents will show you what you're making, but they don't want to show you what happens if you pull the money out early or you start touching the money early. Once again, this is from experience. Don't do it. Okay. So here's what happens. Here's how this looks. Okay. So when you're doing an illustration, it's not a contract. It's just to illustrate what's going to happen once you do this. And again, the interest rates change. So interest rates do change up or down. Okay. And it's all based on market forces. And there are a lot of different types of markets. Okay. All right. Okay. So here we have her at $100 a month, a guaranteed interest rate of 3%. And as you see here at the bottom, at 10 years, the surrender value is $13,853. Now, you may say, well, her it's $1,200 a year, right? So if you look up right here, $1,200 a month, eventually that thing's going to accumulate to over $13,000. And this young lady has I think she has a 2-year-old. So think about it. By the time the young lady's 12, she'll be able to lay her hands on at least almost $14,000 for whatever, right? But she's going to receive a penalty at that point. Now, I believe the penalties go down as the years progress. At year 11, there's no penalty. Most annuities, after a certain period of time, will remove the withdrawal penalty. Now, it will be taxed at ordinary income once you take it out, okay, or once you receive a stream of income, and you have an option to pay the tax then or pay the tax later. Now, talk to your tax professional, because of course you have some states that have no state tax and some that have state tax. I'm not a tax person. I do know a little bit, but I'm not gonna get involved in that. All right, so let's move on. Now, I enlarged this on purpose. So at year 20, let's say for example, at 20 years, let's say her daughter's 22. If she needs something, she'll be able to get her hands on at least almost $33,000. I guarantee you this is going to come in handy. I guarantee. That's what I told her. This is guaranteed. It's guaranteed that you're going to have a need for other forms of income. Now, at year 21, let's say, for example, she wants to start getting ready she'll only be 50 years old. She'll still be young. So she'll have $32,000 that she could just rely on, trust on, right? And then at year 30, she's at almost $60,000. And that's at only $100 a month. Just imagine if once she progresses in her career, whatever choice she makes, and then she says, all right, I want to contribute $200 a month. That's double now. That's over $100,000 at year 30 that she can access or use for her daughter's education, or use to go on a trip, or she could take that money and put it into something else. She can invest in something else. So the annuity is a great product, because especially the flexible premium deferred, because what you do is you set it on bank draft and act like it's not there. So when we talk about deferring gratification, this is the beauty of it. And I felt the need to do this particular presentation because a lot of people just don't understand, especially today's world. And this young lady's 30. So I commend her on allowing herself to understand the power of interest and the power of deferring gratification for later in life. Right. So as you can see here, great product at 3% interest, at 3% on $100. I guarantee you banks, yeah, some interest rates may be going up now, but we know how things work, right? We know that banks sometimes can, I don't know, you can get an annuity at 5%, 7%. Savings accounts, well, I'm gonna stop. All right, okay. So why do you need an annuity? These are examples of what can happen, kind of like what I just talked about. At $100 a month, you're looking at over 20,000. At 125, so look at the things that you're buying over here. Look at what you're doing: movie tickets, tennis shoes, just frivolous stuff. And you can take that same money, put it in an annuity, and then let it work for you. So I'm going to end with 4 questions. Do you know what's going to happen in 10, 5, 10, 15, 20, 30 years from now? No, you don't. If somebody tells you that, you believe them. I have some swampland to sell you. And all right, can you afford to not act now and place you and your family and your community in a better position? What I am doing is teaching people how to build generational wealth using insurance product, something that has been done for centuries, and most people still don't understand what's going on. We rather buy tickets to concerts. You take the same concert money, shoe money, coffee money, and use it to put yourself and your family. And if you want to contribute to a charity, if you want to give back to your university, you can create an insurance product. You can contract an annuity to do that. You can actually leave, and a lot of people leave their universities money through insurance products, but some people don't, and because we're selfish. All right. And then, so how will you outpace inflation during retirement? Inflation is, I need to do a whole nother presentation on inflation. How are you going to outpace inflation? Do you know what's going to happen? What about your family? What about when your kids need to go to college? I personally have 2 policies on myself for particular reasons. I'm going to get another. I'm not going to say something I'm not doing. And then, do you believe in delayed gratification? I'm going to add another bullet point. It's going to say, do you believe in being unselfish? A lot of different insurance products life insurance products allow you to benefit from the life insurance product while you're alive, and annuities is one of those things. Here are some of the carriers we represent. I'm not going to go through all of those. Each one of them do what I'm talking about here to a certain extent, some more than others. Some have different requirements. All insurance carriers, some you've heard of, some you haven't heard of, strive to create products to benefit individuals and companies. So I do have a presentation on the excuses people use as to why they don't have insurance, life insurance, or some type of coverage for now and then. The particular product I previewed today or highlighted today was Royal Neighbors of America. If you would like to get started, please reach out to me. Once again, my name is Max. I am a licensed insurance agent. The agency is River Rock Financial Group, which is licensed in Georgia, Texas, and North Carolina. You can reach me at any one of these phone numbers or at the website rrfgwealth.com, rrfgwealth.com. You can email me at River Rock Financial Group LLC at Gmail. You can reach me on any social media platform listed here: Instagram, Facebook, YouTube at River Rock Financial Group LLC. And until next time, I appreciate everybody that can stop by. Thank you for listening. And if you're ready to get started, go ahead and reach out to me at River Rock Financial Group LLC.